All right, let's jump right in. We've all heard it, right? That magic number people throw around for the stock market. You can expect a 12% return. It sounds incredible, consistent, steady growth. But what if I told you that number is both totally true and also a complete illusion? Let's decode this. So on the one hand, you have the dream, this nice, smooth, predictable 12% climb every single year. But then you look at the right, and bam. That's the messy, chaotic, real world of the Indian stock market. We're talking years where you could lose over half your money, and other years where you could make a mind-blowing 76%. And this chasm, this gap between what we expect and what actually happens, that's where investors get into all sorts of trouble. And here's where it gets really, really interesting. If you average out the Nifty's returns over the last 30 years, guess what? It comes out to about 11.8%. So the number is correct, but, and this is the part that nobody tells you, in all of those 30 years, the market has never, ever actually delivered a 12% return. I mean, literally, not a single year. It was always way higher or way lower. You know, this leads to the single biggest confusion that trips people up, especially when they're starting out. We see those crazy up and down swings in the market, and we immediately think, whoa, that's way too risky for me. But what we're doing is confusing the day-to-day noise of the market with the actual, real danger of permanently losing our money. And trust me, they are two completely different things. So what exactly is volatility then? Honestly, the best way to think of it is just the market's personality. It has good days and bad days. It has mood swings. That up and down movement is totally normal. It's expected. It's the price you pay for a ticket to the show, a show that historically offers much higher returns. Now, this is what we should actually be worried about. Risk. Real risk isn't your portfolio value dipping for a few weeks or even a whole year. Real risk is the actual possibility that the money you put in is just gone for good. It's not coming back. So the big question for any smart investor is, how do we tell the difference between temporary volatility and the permanent danger of real risk? And this table here, it lays out that trade-off perfectly. Look down at the bottom. You've got your savings accounts, your FDs. They feel super safe, right? Very low volatility. But the returns, barely there. Now, as you climb up this ladder towards things like large cap and small cap stocks, you see the potential returns just explode. But so does that short-term volatility. It's a crystal clear picture. There's no free lunch in investing. If you want higher returns, you have to be willing to handle a bumpier ride. Okay, so if those bumps and swings are unavoidable, what do? Well, it turns out every single investor has a superpower. It's a tool more powerful than any complex trading strategy or hot stock tip. And that superpower is time. Let's see how it works. Just look at this chaos. If your plan is to invest for only 1 year, you're basically at the casino. It's a total coin flip. You could have an amazing year and make over 75%, or you could get absolutely crushed and lose more than half of your investment. This is pure, raw volatility, and it's why trying to make a quick buck in the market is so incredibly dangerous.
But now, watch what happens when we just change the time frame. We don't change the investment, we just give it more time. It's like magic. Suddenly, the chaos disappears. The storm calms down. By staying invested for 10 years, even the absolute worst 10-year period gave you a positive return of more than 6% a year. The scary short-term swings just get smoothed out into a much more predictable upward trend.
And this right here is the whole secret. Time is the magic ingredient. It's like an alchemist. It takes the worthless lead of short-term scary volatility and literally transforms it into the gold of long-term opportunity and growth. Your patience is what turns all that noise into wealth. But look, don't just take my word for it. Let's get our hands dirty and look at the hard evidence. We're going to go through the Nifty's actual 30-year journey, and the numbers, well, they tell a pretty amazing story. First things first, let's just get this out in the open. Down years happen. In fact, they happen a lot. Out of the last 30 years, the market has finished in the red for 9 of them. That's almost a third of the time. So right away, you have to go into this expecting to have bad years. They are a normal, recurring part of the deal. And let's be honest, some of those downturns are absolutely terrifying. I mean, think about the 2008 global financial crisis. From its highest point to its lowest, the Nifty fell a gut-wrenching 60%. 60%! That's a number that can cause real panic. But that's not where the story ends. Because that brings us to this. This might be the single most important number we look at today. After all those down years we just talked about, after that heart-stopping 60% crash, how many rolling 10-year periods in the last 30 years have ended with investors losing money? The answer is zero. Zip, zilch, not a single one. Patience, over any decade, has been undefeated. So, if the data is so clear that staying in the market for the long haul works, then what's the problem? Why do so many people have a bad experience? Well, here's the plot twist. The biggest risk to your long-term wealth isn't the stock market, it's the person staring back at you in the mirror.
You know, there's this old saying in investing that just hits the nail on the head every single time. It's that far more money has been lost by investors trying to get in and out at the perfect moments than has ever been lost in the market crashes themselves. The damage we do to our own portfolios, driven by fear and greed, is often far worse than anything the market does.
And this is what that destructive behavior looks like. It's a tragic cycle. The market's hot, everyone feels like a genius, so we buy in with confidence, usually near the top. Then, inevitably, the market crashes. Fear takes over, we sell everything in a panic to stop the bleeding, and then what happens? The market recovers, and we're stuck on the sidelines in cash, having missed the entire rebound. We systematically buy high and sell low, the exact opposite of what you're supposed to do.
So really, we have to completely flip our definition of risk on its head. We're programmed to think that short-term stock market volatility is the big scary monster. But the real silent killer of your wealth? It's inflation. It's your money sitting in a safe savings account, getting its purchasing power eaten away, day after day, year after year. Not keeping pace with inflation isn't a risk, it's a guaranteed loss over time.
Okay, let's put this all together. This is your new investing mindset. First, volatility is not a fine you pay, it's the price of admission for higher returns. Second, time is your absolute superpower. It's the ultimate weapon against risk. Third, because of that, market crashes aren't threats, they're opportunities, they're sales. And fourth, and most importantly, your reaction to the market is a far bigger risk than the market's action itself.
So I'll leave you with this one final question to really think about. The data is clear. The next time the market is tumbling and you see all that red on your screen and you feel that panic start to bubble up in your chest, just stop and ask yourself, is the roller coaster the real danger, or is it my urge to jump off in the middle of the ride?